Morning, everybody. I hope everyone has been able to log on within a reasonable amount of time. It took us a while to get on, both Dr. K and myself. It's probably a server issue on their end. That's what I'm guessing. So it is a bit slow. We gave people some more time to log on, and I think 9 minutes after the hour is long enough for anybody who's going to show up. And we basically waited till the end of the week. We wanted to see what the jobs number was. Before having the webinar. We thought you're probably closer to an inflection point, if any, at that stage. And the jobs number this morning, I suppose, Dr. K, am I reading that right? It was actually higher than expected because they were looking for a decline as a result of Hurricane Sandy.
Yeah, and then of course joblessness went down to 7.7% from 7.8,
Right.
and that caused a huge pre-market spike in the futures. And I'm not surprised then to see the market retracing here.
Yeah, coming back in. I mean, basically what you got going on here is the NASDAQ, you can see today, is running into resistance at the 50-day, and now it's back below the 200-day moving average. Seen a few more of the bigger NASDAQ stocks off today, like Google, for example. I think also Amazon. Actually, Amazon has been hanging in there pretty well. But you can see what's going on here, and you may be at an inflection point because you can see how you're kind of rolling off the peak. That's not really clear yet, and so you have to take it on a stock-by-stock basis, on a day-by-day basis. And my primary view here is to look at the rally as being shortable. So not that I won't come in and test the long side briefly to see if there's anything pushing to the upside. The real key here, I guess, and this is what the crowd knows, is that the fiscal cliff, it all hinges on the fiscal cliff. If we go over the cliff, the market's going to crash 1,000 points. I've heard that. If it passes or we get a compromise of some sort, there'll be a rally of 1,000 points. You hear all sorts of permutations. But I think the bottom line is you can just take the action on its face. And we can assume that there's going to be a rally, and a big rally, if there's some sort of fiscal cliff resolution. But I don't think you can necessarily make that conclusion, and I certainly wouldn't be trying to predict what the market's going to do on that basis. I do think that provides justification for a rally, and so you do have a rationale and an alibi for the rally. But it's pretty scant leadership, is what it looks like to me, and you're seeing resistance here at logical places on the move is, and on that basis here you can see the S&P also resistance today at the 50-day. And are we trading more volume today, Dr. K?
Let me see here.
Yeah, running lighter today. So, the rally this morning, no juice in it, no gas in the tank. Anyways, market direction models on neutral. Dr. K, what's your take on it right now in terms of the status of the model and where you see the market?
Well, it's pretty much what you said. The market's in an uptrend, but it seems relatively weak. We're in a seasonally strong time of the year, but the leadership isn't there. And Apple spiked yesterday after retesting lows to some extent, but there's nothing really out there that's convincing that this rally has legs. On the other hand, you have QE, although QE hasn't really been much of an effect. I think really the more of the pressing issue is the fiscal cliff issue. We've got the Democrats who can just let us slide over this cliff, and actually they can then blame the Republicans. So there's no guarantee necessarily that they're going to come to some sort of agreement. I think that keeps the market nervous, and I think that adds to the volatility and therefore risk inherent in the market environment right now. But the model, in the meantime, is in cash simply because we could just as easily rally as we could just as easily roll over, and without enough directionality and guidance, the model's better off staying in cash. I can't hear you. Can you turn your mic up?
Here we are. Sorry, I had it off. From my perspective, also, shorting stocks is probably what your best bet would be if you're trying to be bearish on the market or play some of the weakness in a lot of these names, and the lack of leadership. So to me, the lack of leadership says not really a great environment to go long. There's a few things you can probably trade, and we tried a couple of those with minor success, but it's fleeting as well at times. But on the long side, or short side rather, you can see things starting to set up again. And so I think on that basis it's much easier. I notice if you're trying to trade, say, the SQQQ or the SPXU ETFs, the index ETFs, they're all over the place and kind of hard to deal with because of the volatility in the indexes. I think it's a much clearer idea, especially after the last few days. You can just see this chop, 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 and back and forth, and so you're not getting any movement in these things. So I think the big story obviously is Apple on the short side, and of course we were looking at picking it off in here. Once it started to gap down here on Tuesday, to me that was a sign to go after it aggressively, and you got a big break the next day, and then yesterday you had this big break. And what's interesting here, I was looking for it actually to undercut this 505.75 low of this day, and I'll tell you what my rationale is for that. You can kind of see this little head and shoulders. Here's a left shoulder here. You can see a big head and a little right shoulder. So you kind of have a weird little neckline in this pattern, and it's just kind of a mini head and shoulders there. And so you have this neckline down around the 520 zone. So that may be why it found support there. You also undercut the closing prices here, even though you have this long tail to the downside. It was enough to get around. You see the volume come in. There is this sort of inverse greed that goes on with Apple that I've noticed, where you see people, once it starts going to the upside, you see people just pile into it because, of course, it's cheap. And Dr. K and I actually just put up an article on MarketWatch.com talking about why it isn't necessarily cheap, and the whole idea of using PEs to assess a stock's upside potential is entirely flawed and a recipe for great pain and distress. Would you not agree, Dr. K?
Yeah, plenty of examples abound throughout history where PEs can trip investors up. In fact, it often does, just because the media put such a light on this level of importance on PEs, but they're really quite irrelevant. I mean, more in context with the actual stock are PEG ratios, where you have basically a stock that has very high growth rates, say in line with its current PE, but then the future growth rates are going to accelerate. That's a favorable PEG ratio. In other words, the growth of that stock is going to, the percentage growth is going to exceed the current PE of that stock, and that could be a very bullish, well, I would say one bullish indication on that stock.
Yeah, the other interesting thing about Apple, I mean, point this out in the article, is that at this point in time, it had about a 47 to 56 PE ratio as it was coming out of this base and just starting its move. And as it's gone further on in its move, the PE has actually contracted, interestingly. But I think that does tell you how the market perceives the forward earnings stream of the company. And so what you've got going on right now is this sort of head and shoulders now in the weekly. You notice I was pointing out this little mini head and shoulders you could also look at right here. So there's different ways to draw this. If you like to draw lines, and I should emphasize that that's really all they are lines, and you can draw them all over the place. So you could say, here you have a pretty clean neckline here, and then another neckline here. So it's headed maybe for these lows, and my guess would be that's probably the case over time. This could take longer. You could have more right shoulders, but I think you're going to get a series of moves here that are shortable on a short-term basis as you're waiting for this major breach to occur, and that may be when the stock really breaks to the downside, if that ever occurs. There's no guarantee that's going to occur. If these guys come up with some new product like an ITV, maybe that drives another cycle of growth for them, and you see the stock come out of it again. But that's kind of what it's going to take. But the stock is telling you what's going on with the company right now, I think, and on that basis, you don't want to be trying to go aggressively long. I actually did try to go long the stock this morning, thinking you might get more of a rally of another day at least, and there's nothing doing it. Reverses, you go short again. And the hero trade comes back into play, which is looking for an undercut of this low down here eventually. And that looks like it could occur. I mean, it could also be a retest here. You get big volume buying. You see how people just kind of jerk in here and they got to buy the stock because they missed all this. And, of course, has a right to go right back up, right? Wrong. But in any case, that's kind of what you're looking at right now. So we'll see how this acts. But it's just kind of fluid right now. And you're in this break to the downside. You got one-day rally. I don't know if that's a low. We'll see how the stock acts over the next couple of days. But you're in a position where you could potentially rally to the 20-day, which is 560, or even up to the 10-day, 571. I mean, it's even possible that you get a rally all the way up to the 250-day moving averages. You also notice you got the 50-day now is in fact crossing below the 200-day. So that was more ominous last week or earlier in the week. What is all this garbage? I got to get rid of this. Earlier in the week, actually last Friday, when you had the 10-week cross below the 40-week. So, that's kind of, I think, a focus in the market right now. I'm looking at some other big stocks.
The Apple stock has had the biggest correction since early 2009, and I think the market's telegraphing that, well, on a fundamental level, they've gone through, they've released all their exciting products. The iPhone 5's out, the iPad with Retinal display. They're going to come out with another iPad in 2013, but it's not that exciting. I mean, it's going to have improved Retinal display. I don't think that's really very groundbreaking. So, and they redesigned their products, and so there's an issue that Apple's not going to have any game-changing or some sort of technology that they're going to be issuing to the public. I guess this Apple TV is very speculative, and there's no indication of when that's coming out. And even when it does, is it going to be, as groundbreaking as the iPhone and the iPad? I don't know. That's a big if. What if? So in the meantime, the technicals are telegraphing some bearish action here for the first time since early 2009.
Okay, let's see. I'm just kind of going through questions. So, I'm looking at Apple, Google. You'll notice bumping up into the 50-day. So on rallies up into that, I'll come in and put out a position on it and see if it breaks. But you're in this big head and shoulders. The one difference between Google and Apple that I think is important, but it doesn't mean that it can't top, is that stock's coming out of this really long consolidation. And unlike Apple, it hasn't had this massive price run, unless you want to consider some move, say, from here. But that was a pretty long base, a 2-year base it's come out of, almost, let's see, 2010, 2011, almost 3 years, actually, well, 2.5 years. And so you pulled right back on top of that, and now you're bouncing into the 50-day. This is another one on my target list. Right now, some other stocks I'm just going to run through real quick on the short side. Agrium is a breakdown. You see the gap down. It's bumping up into the 50-day. That's possible short using the 50-day as your upside guide for a stop. Fossils had this reaction rally after undercutting the lows, so this may start to roll over. That's a possibility too. It could rally as high as the 200-day, but kind of keeping an eye on it. Again, you can always use the 620 model or that 5-minute chart that I've shown you guys many times before to come in on a daily basis and test short positions if that's what you want to do. And you can see today, if you're looking at Apple, you had a clear. Let's just kind of pump this one in here. It's at the bottom of my short list based on performance today. Let's see. Let's go to a 5-minute. It's not really going to show it, but if you were looking at the 20 period and the 5 period moving averages that we use, you would see sell signal earlier today, and it's actually held up pretty well so far. So the stock's right now 538 and change, so hanging out. So we'll see what happens. It's kind of in play, I think. Right now, this could roll over and just die again, or you could sputter around and then try to rally again. A lot of it's going to depend on what the general market does. So Apple being a market stock, but there are other stocks to keep in mind, or to keep an eye on, rather. And Mellanox, we talked about that a couple of weeks ago, and it did finally break down. Remember, I was complaining I couldn't short any, or I couldn't borrow any shares, and I was kind of ticked about that. But notice how it's come down and undercut this low, so you get this kind of reaction rally. Now 70 level is potential resistance, but it could rally higher up into the 200-day moving average, which is around 74, 71 right now. So anybody who was able to borrow shares, if you're short that, that's kind of how I would look at it right now, just kind of watching this rally. Generally, though, on an undercut like this, you might cover some if you played some of this move and then look to reshort once it finds some resistance up here towards moving up towards 70. Baidu is another one that's broken down. And remember, I was telling you guys, I went short. I'd look for a rally up towards this 100 level or up into resistance in here. But you got this 100 level is very key. So it rally right up into it and then rolls over again and breaks out to the downside. Now you're bumping up. Yeah, I think this thing's in a long-term top. If you look at the weekly chart here, it's broken down from this big rolling kind of head and shoulders thing. It's multiple heads, multiple shoulders. I call it a head and shoulders. The head and shoulders of Notre Dame. So it's just this kind of ugly looking thing with a bunch of humps in it, and it's breaking down, and I think you're undercutting the level here. You briefly did that 3 weeks ago, and you rally up a little bit. So now I think you're heading for this level. Notice how you did come down, and you find support on top of that. But I think long-term Baidu's done, and I would be looking, if I'm campaigning this, I would just be looking to rallies to short into. You know, and I think it becomes, at this point, you guys should all be pretty familiar with how to do that, and using the proper, looking at resistance levels, and of course understanding that nothing is 100% certain. So I did get a question from somebody asking me if they were shorting LinkedIn and using a 110 stop, and they asked me if that was logical, and my answer is if a 2 to 3% upside stop fits within your own risk tolerance and the risk parameters that you're setting for the trade, then it's totally logical. But does it mean it's going to work? No. But I think that's reasonable. You know, the 50-day moving average could be resistance for this thing, and it has broken down in a sort of a late-stage base failure. I don't know, you know, what you call this. If this is one big first stages, I don't know what it is, but it's a big base failure no matter what, and somewhat pod-like. And so you're up in here. Yes, this could break down, and so if you want to short it, a logical way to approach the trade is to use this high at 110, which also coincides with that high. So that seems to be pretty decent resistance there on the upside that you could use as a guide for an upside stop. Let's see. That's true. Lulu was not. We didn't really see it as a Bible pocket pivot, because remember, this is kind of V-shaped, so you get this break below the 50-day moving average and then this reversal. So it's a little bit suspect, and obviously if you did buy it, you'd be going nowhere. So if you really love the stock and think it's going higher, then I guess you could buy it using the 50-day moving average as your selling guide. But I don't consider that a proper pocket pivot. Dr. K, your take?
It's not a proper one. I mean, it's tempting because you know, the earnings news was good. The earnings and sales were ahead of expectations, but the pattern leading up to this formation is very suspect. I mean, you had a mini gap down on big volume on October 19th. The pattern is not really, I mean, it's been trading under the 50-day for a long time. It's finally coming back up through there. And, you know, this is not the only time you've had this mini gap down. You also had a gap down in, it was June 7th. So there's defects to this overall pattern. There's too much risk, especially in this kind of market environment, to play something like this.
Yeah, definitely. So what do you do? Short it? No, I wouldn't short it. It doesn't look like it's ready to blow apart just yet. A lot of shorts have been in that stock. So let's see. Let's talking about fossil Priceline. I think Priceline is interesting because you wonder if this is going to fail here, and it's just a big broken down pattern that's just a big rolling top, you know, and so you do get this action here. But it is above the 200-day moving average, so you might look for some sort of breakdown through it, but it has been getting resistance up here, so as a short, you know, that's a possibility if the market rolls over because of the position it's in. If you are using the resistance here, which would be on the left side, around 695 as a maximum upside stop. So remember, that's only 5% higher. You got to remember with these $600 stocks, keep the price moves in mind. You know, Apple moves 10 points, that's less than 2%. So nothing really to get too excited about. The ever-present TVIX questions. Dr. K, what's going on with the TVIX?
You mean the UVXY model, or do they mean specifically TVIX? TVIX, I think, is going to be phased out, and I think they're, you know, it's just only a matter of time before they delist it. Yeah. But you know, the other instruments, VXX, XIV, UVXY, those are fine. They're trading fine, plenty of volume. And what generally will happen is as UVXY drops further in price, they'll just reverse split it like they've done before. They've done this twice before, and that'll just keep the price more in line, and you know, so it's trading at least, you know, $12 a share or more. And generally, they reverse split it so that it goes all the way back up to the 30s or 40s.
What is the signal you have on this model right now?
Cash. It's the bid in cash. It means, in a sense, more of an opportunity. But again, there's, you know, with this gap up, gap down risk on the basis of the fiscal cliff, the model senses it's better to be in cash and really pick its spot. Now, under more normal conditions, it wouldn't be so tentative on the markets, but we are in the environment we're in, and we've still got to the end of this month for this fiscal cliff issue to resolve one way or the other. And in the meantime, I wouldn't be surprised if you see this model just sit in cash for the time being. It's possible everything will set up and go, and we'll get a nice little Santa Claus rally. That means, accompanied by a lot of other indications of bullishness, in which case the model will probably issue a signal. But that's really the future. The future doesn't exist. We'll have to see what happens.
That's an interesting question. Somebody's asking, can you talk about a little bit about your trade statistics, e.g., winning or winner-loser trade ratio? You and Dr. K have different styles. What does this mean for the above ratio and other statistics?
Well, as we know, the win-loss ratios.
That's irrelevant. Yeah, we don't operate on that basis. We can be wrong 5 times in a row, and you're right once big, and you're like up huge, right?
And yeah, Bernard Baruch said that that's the least meaningful statistic, and it's the one that unfortunately investors pay most attention to. And again, 1997 was a perfect example. My hit rate in 1997 was less than 20% success. In other words, more than 80% of the trades I put out were losses, and yet I was still able to finish the year up just over 100% because I made it count. And also, that's a big part of position sizing strategy and being able to know that as a stock is proving itself, you may want to add to the position. If you're doing many different stocks, many being, my style is to do 10 to 15 stocks when the market's good, then I'm cutting my losers pretty quickly. So I'm going to have a lot of small losses, but the ones that work are going to really work, and that makes all the difference to an account.
Yeah, and I would give it one of the starkest examples. So that 8 bad trades in a row, and I was down 30-something%. And boy, I really thought I was a loser at that point. And then I had to cut C-Cube Microsystems, and I was up over 500 on the year. So, win-loss ratio is, and I would throw out all these notions of trade statistics and everything, and the fact that you have to be right all the time. And I think we've made it clear in these webinars that we show you how we're looking at the market, but we are allowing for the fact that we expect to be wrong, and I expect to be wrong at least half the time. And that's just the way it is. So, I hope that doesn't burst anyone's bubble.
In the best market environments, I remember O'Neill saying, in the best bullish environments, his success rate at best is 50%.
Yeah. I'm looking at some questions. I want to go through some questions before I go back on my short side rant. Chipotle, well, you can see it's coming into the 50-day moving average, so if you think it's going to roll over again, this is the macro pattern. Does it have potential to go lower? Oh, yeah, definitely. So, if you wanted to try shorting it, this might be a spot to do it. You could still go through the 50-day, though, keep in mind, and rally up to this high. So, moving averages are not made of concrete, at least not the last time I checked, so the stocks can sometimes push through them a little bit, sometimes 5%, 3 to 5%, and then roll over from there. So this would be a spot, though. Your high on the day is 270, 298. You're trading, 269.56 right now, so 268.20. Is that right now? What are we at? Last. Is that low or last? Well, no. 269.56. Yeah, that's where we're at. It's right there. MA topped out, somebody says. It's possible. I don't see the break through the 50-day moving average. That would be the first sign. Otherwise, I'm not going to make any assumptions about that. But it's possible. And if it does, here's the weekly pattern. Been in a steady uptrend. If it did, that might be serious consequences for the market too. So, I don't know. But I wouldn't short it. It's not something I would short. Everybody's asking about CMG. That's interesting. I'm going to go long it, I think. Everybody wants to short it. Someone says, when you say about 10 or 50-day line violation, does it bother if the violation occurs not in the real body but in the low shadow of the candlestick? Huh? I don't really understand that question. Do you, Dr. K?
If they can rephrase it.
Yeah, low body of the candlestick. I would say all it needs to do, we don't even pay attention to candlesticks. Just say look at this move here, right here. Let's blow this up. Okay, here you can see the stock closes below the 10-day moving average here, and the next day it moves below the intraday low of that. So you're stopped out at that point. That's a violation of the 10-day if you were using the 10-day moving average as your selling guide, but you wouldn't in this case because after the breakout it immediately violates it. So you're not using the 10-day, you're using the 50-day. Now notice here you have the intraday low and a close below the 50-day moving average, but you do not see the next day it goes below that low. So that's not a violation. So I don't know if the candle width goes to that low, which it should if you have a wick on the downside. That would be the intraday low. So that's the only thing I can kind of glean from that question. That's what you're asking. CME is topped out also. Wow, a lot of stocks topping out today. I've been looking at this one to tell you the truth, and it looks like it wants to go lower. It's not a classic sort of short sale pattern, and it probably wants to go lower. I don't know. If they start putting taxes on trading, you can pretty much bet on that. So, but I don't know if I'd short it. How do you find all these stocks? Is there a certain screen you do? I don't know. We look at how many charts do you look at a day, and then on a weekly basis, Dr. K?
Oh gosh, it depends on the market environment. If we're in a bear market and there's very little to be bought, I'll run some short screens, but it's really far few between compared to an outrageously good bull market where I'm running my screens, throughout the day so I don't miss anything. And I'm going to look at, geez, at O'Neill, I think I was the guy who had looked at the most charts, or at least that's what the head of IT said, and that was during the go-go bull markets. And I could easily be looking at easily hundreds of charts in a day, if not considerably more. And when I'm also doing my research studies during the day, I'm going to look at lots of charts as well. So it adds up.
I actually looked at that run, Dr. K. So I saw the run of how many. I would see the reports on Wanda usage internally. So, and you and I would be somewhere around 12 to 15,000 charts a week.
Yeah.
So we both looked at a lot of charts, but the other guys were pretty close too. And it may just be that they had better screens and didn't need to look at that much. But in any case, we look at a lot of charts. That's basically what happens. One of the things I run as a screen, is a very basic one, is stocks with a composite rating over 85, and I run that screen. You get a couple hundred in a good market, maybe 300 stocks that fit, and then I just keep an eye on them and go through them constantly in real time. We're just kind of maniacs about it, That's the only way you could describe it. But that's kind of how you do. You get a basic screen to get you the best names, and then in a bear market, the way I build my short list is as those former leading names, all of those that were on that buy list that I was screening for in a good market, when the market turns into a bear, then what I do is, as those stocks are breaking down on high volume off the peak or failing from late stage bases, they get shifted to my short list, and that's how my short list gets built up. I don't really run any screens, a lot of hectic screens, detailed screens on the short side at all. It's just I'm using a list of the leaders that are broken down. So. I love this question. Is there going to be a Dr. K international direction model soon? They said that was sarcasm. It says. I don't know what that means.
Yeah, well, markets correlate, so you can. We have actually gotten questions about applying the model to other markets in emerging markets, and since they tend to be a lot more volatile, therefore there's more potential profit, but more risk as well. But no, I haven't been looking at that, but it certainly could be extended beyond what I've looked at.
Goldman Sachs is a stock I've been looking at. You got this big cup with handle, and then you break down and you're flittering around the 50-day. I think this has a good chance of breaking away. I kind of been looking at it. If it bumps up in here, hit it, short it for a day, and it moves down and comes back up, and it's just kind of hanging out there. I think if the market breaks down, it'll go. But Goldman Sachs is a name to be looking at. It's kind of a weird pod, but in a weird formation. It wasn't a hot stock. It was a crappy stock, and it's been in a big, fat downtrend since the financial crisis, basically. You had a big pod here, and now you got these double pods, the double D pods, as I call them. You can figure out why, but this looks like it's shortable, and I'd love rallies up in the 119, 120 area to put out a short position on it. But it looks vulnerable, so yeah, and you even got this little mini head and shoulders, so it's looking weak. And the only thing that would stop you out in that case would be a move up above the 200-day at 119.23, which is what, a couple of percent away. So pretty tight stop from here. AutoZone, I noticed that was getting blown apart the other day, and this is a daily chart. Yeah, it's blown to pieces, so you have a late-stage base failure now. So what you're looking at is you do get the breakdown. Maybe it undercuts this low here, which is 351.21, and then it tries to rally back up into the line. But this one would go on my short sale list on the basis of this breakdown. And so, yeah, this is what you're looking at. Now, notice it had a breakdown way back when, but the interesting thing here is you have gone through the 200-day or the 40-week line now, whereas you actually were able to hold it last time. So that may be significant for the stock, but you can see the whole thing's leveling off because the 10-week line here has dropped below, and I think it's just barely riding above by a buck, yeah, by a point above the 40-week line right now. So, that's all weak. A lot of these patterns look weak, and that's the problem with the long side, and why a lot of these, losers are becoming short sale setups, and AZO would go on your short sale list. So, let's see, anything else I'm looking at? I've been watching Trip, kind of a big, I don't know, right shoulder here. Maybe it gives out in here at some point. Notice how you're running out of gas. So you're up in an area too, potentially, under this area of congestion here. You spread it out. You're coming up in there. A lot of times you got to watch these for a long time, and they'll even look good at certain points, but eventually if the market rolls over, they go with it. That is a big breakdown pattern. I don't necessarily see this thing making a big comeback anytime soon, but it has persisted in its rally, and it has not backed off at all. Somebody notes, Dr. K, you can maybe address this. Shanghai had a day 4 follow-through last night, and ETFs for Australia, Singapore, Taiwan, etc. are at highs. That's part of the international question, by the way. So.
Okay. Yeah. I mean, there's obviously correlation with a lot of these markets, and I studied and invested in instruments like FXI that were leading the way, but that's more in context of the market direction models, not the systematic, but the discretionary portion. For instance, in 2005, 2006, the Chinese market was leading the way. So the model, when it would switch to a buy signal, would be potentially more focused on FXI, and that would be the way I would trade it. And so for BSI members, when China does get back up and starts leading the way, I think it's just only a question of when and not if. Then the model will take that into account, and you'll see that in the list of recommended suggested ETFs, FXI, in that situation.
Somebody's asking, would you add any more IBD ratings or technical criteria to your 85 composite rating screen? No, you just take those names and you just start running through them. And you can, siphon out the ones you like on the basis of what's going on with the earnings and the sales. But as long as their composite rating is above 85, I think those are the best stocks in the market at any time. So I do think the composite rating was developed in around 2002. I remember when I was still at O'Neill. Dr. K, you had departed by then, and
they had a lot of different of these indicators, and some of them had really unusual parameters back in
right.
I think 99 2000. So I redesigned some of these parameters just to bring them more up to date. But the composite rating was something that occurred, I think about probably like a year after I left.
Right, in 02, 03. And I remember we had a database, they put together a backtesting database, and that rating is pretty good in my view, knowing how it was developed and the success that it showed on the backtest. So, but it took some time to build a backtesting database that was used, and I think it's more extensive now that they use. But the composite rating, I think, is an awesome rating. It picks up sometimes stocks that don't have the 80 EPS or relative strength because there's some other things that can be factors in a stock's outperformance, and I think the composite rating is great. So all you need to do is look through that list, and there's no reason to screen out. I don't screen out technical indicators because it's very hard to get a screen to pick out certain patterns or things like that, or technical characteristics. You can just eyeball them. What do you do, Dr. K?
Sorry, you blanked out there again. Can you just rephrase that?
In terms of running a technical screen overlay to the IBD, if I have a list of the all stocks with a composite rating over 85, do I then
Well, I have, yeah,
need
I
to,
have
whittle that down on the basis of technicals? And I would say you can
liquidity and
thrive on that.
price. Liquidity generally.
Yeah, maybe liquidity. Yeah, it's got to trade a certain amount. I mean, that's one
Some of those
way.
stocks are going to be on the thinner side. They include a whole bunch, and I want to whittle the list down. That's one good way. Sometimes I also use relative strength. I'm focused in a stronger market on stocks that are more primarily in the 90s, relative strength 90 or above, sometimes even higher than that. So yeah, those would be two big filtration systems that I use
Yeah,
just
and then
to keep the screens manageable.
and I remember when you'd have a follow today, if you ran a screen, anything with a composite rating over 90 and I forget what the it's a ratio of daily volume to the float, and that's a certain supply-demand criteria, and we used to overlay that. And if you got a 95, I took every stock with a 90 composite rating and a 95 supply-demand rating or higher. At the point of a fall, you pretty much have the initial leaders right there. So I remember that. So, but I remember the composite rating it's very useful. I'm noticing Google here. It's reversing back to the 10-week line, even though it never got to the 50 today, but it did last week or earlier in the week rather. It's starting to roll off and turning red here. Apple also is not really rallying, even though the market, you're seeing the S&P up 0.05%. That's a big move, and the Dow's up 41. You notice the outperformance in the Dow. Some of that strikes me as defensive type action. It's very subtle, but that seems to be what's going on. Meanwhile, you still have this divergence in the NASDAQ, and a big part of it is Apple, but you also have some other stocks. Priceline is down, Google is down, Intuitive Surgical is coming off. You see stocks like some of these have been in a downtrend. So it is a lot of that the other day was Apple, but there is starting to be a divergence in the NASDAQ versus, say, the Dow versus the S&P. So, somebody asked if RKUS is in my radar. I have to tell you it isn't, and I'm guessing it probably doesn't trade. It's too small. Ruckus. I like that name though. That's a great name. Ruckus Wireless. Let's make a ruckus. So no, really hasn't hit. I mean, it's trading. Got a couple of spiky days here, but it's kind of a thin new IPO, so didn't really hit my radar yet. It's got to trade certain average volume. I don't think it's there yet. If you take out these days, what about you, Dr. K? You seen that one?
It's interesting. A lot of these IPOs can really take off, as we all know. The fundamentals are quite impressive. Sales and earnings. So I think this is one to definitely keep an eye on. And if we get a good pocket pivot, you could argue that we had a pocket pivot on the 3rd of December, but again, in this market environment, we know IPOs are going to be a lot more volatile. So you need to be careful with these sorts of names. And it's barely, in terms of liquidity, it barely makes the cut. I mean, it really is kind of borderline. It's about $1 billion company, and it's trading on the pocket pivot day. It's trading at 14. So I would, it's not a risk I would take in this kind of environment. But going forward, now it's going up, and if it has another pocket pivot after consolidation, that might be worth revisiting.
Yeah, I'm also trying to figure out what the future of the company is. I guess I'd have to understand this a little better. But I noticed that the return on equity is really no. Pre-tax margins are pretty low, and in the last quarter, they're 9.3% after-tax quarterly margins, which is also pretty weak. So that's somewhat questionable. But their earnings are also somewhat erratic, but they have achieved profitability over the last 6 quarters. But you see a bump last quarter or 2 quarters ago up 28 cents, which is a 2,700% increase in earnings, drops to 7 cents in the most recent quarter. And I'm wondering why. I don't see any special items there, even though sales were up 85%. And margins went from 42.2% to 9.3% after-tax quarterly margins. That seems kind of odd. It's a little weird. I need to understand this more. Somebody maybe
why
knows.
did it go to 28 cents in 1 quarter? That's a lot. That's a huge spike. And there's notation that there were one-time gains. But they are in a great area. I mean, they're effectively they're addressing network capacity issues, and networks have that that's a key issue for networks. And I noticed that their client base is geographically very dispersed, and quite evenly balanced between the Americas, Asia, Europe, Middle East, and even Africa. So,
Yeah.
on the other hand, they say 3 distributors accounted for 40% of revenue. So then there's a little more risk there if one of the distributors backs out. And I'm not real clear on yet on what the playing field is. I mean, do these guys really have first mover advantage, or is the space incredibly competitive? I would think it's incredibly competitive, therefore adds more risk to this kind of company.
Okay, I think we covered that one pretty well. Let's see. Pull up some other questions here. HLF, somebody's asked. So this is another one. I think this is in position here, possibly. You can see that what it did is it came up into this area. You got some congestion right here, so it can come a little further. It could even get as high as a 10-week line on the weekly chart. But you can see this big, ugly head and shoulders, and it's pretty big and ugly. And it's looked beautiful for a long time, but it's never broken down. But you could try probing into this rally using today's high as your near stop, but it could go as high as the 50-day, which is 48.49. So just keep that in mind. Not my favorite short. So I'm more interested in just beating on Apple and Google. I don't know why. You just wait for them to rally, and then you come after them, and then Apple breaks down. Apple to me seems like the classic stock that everybody loves and is the great big leader that everybody owned, and the more that own them, the more institutions in the stock, the harder they can fall when they start exiting. So that's why it's a favorite of mine on the short side. Even though I did go schizo this morning just briefly to try the long side up, and I flipped back the other way to get short again. But sometimes I need to do that just to test how weak or strong it is. So seeing the long position not really working, you can even see anytime it tried to rally, you'd see him just come in and hammer it back down. So I think the stock's for sale. It's just a matter of how much it wiggles from here, and I think it's going lower. I think you'll see it in the 400s. Not too long from now. I know that's a bold prediction. So, and that actually gets some people angry. So, right, Dr. K? Which is a weird reaction because, we don't, if it goes up, we'll go long. If it wants to go down, I'm going to go short. I don't have any love for Apple. I like my iPhone, and it works very well for me, and I like my iPad. And my daughter loves her iMac thing that's like a piece of paper. So, great products, but the stock, is probably everybody owns it. Somebody asks, why do you call volume thin? I guess as on the ruck, it's kind of hard to tell what the volume is, but you have a couple of spiky days in there, so we just give it some more time. Someone else is asking, can we discuss long positions or stocks we think are long positions in this market? We don't see any we would take a shot at. We've put out some pocket pivots on Valeant Pharmaceuticals, and that's moved a little higher, but there's no big moves here. What else has there been that we put out recently? Commvault, there's a pocket pivot here, but it's not going anywhere. So we've had some pocket pivots that we've identified, but I frankly don't think you're in a bull market. I think you could be starting a new bear market, and that's kind of where I'm leaning right now, right? Dr. K, your comments? I know you're less aggressive on the bear side.
Yeah, I mean, basically, we know that the market environment has more risk right now because of the fiscal cliff issue, and the quantitative easing effect doesn't seem to be helping anything for the first time since they started QE in earnest in early 2009. So these are big red flags for the market in general, and not having the leadership that we want to see is kind of the nail in the coffin. So for me to buy a stock on a long side in this environment would really have to be quite exceptional. And other than that, if I did, I would also probably take only half the position because it's the risks are very prevalent.
Yeah, I mean, we were even toying with the idea of buying this one, but it looked great for a couple of days, and they slam it back in. Now you're wedging up, and I don't know. Do I want to buy that Stratasys? Another one here, it looks like it's breaking out, and then slam, they knock it back in. So, to me, the long side is just not there. It's not there, and that's fine. You go play the short side or stay in cash and work on your golf game or whatever it is that you do to pass the time and relax a little bit, but leave the shorting to the maniacs if that's what you want to do. But it doesn't look to me like you got anything going here that's worthwhile on the long side. So maybe that's just me, and I've tried a couple of things, but they don't seem to go anywhere. Anyways, let's go. Let's go through some more questions here. Somebody says, Mellanox, even with the breakdown, it still has a composite rating of 90. Price volume action. Yeah, I mean, you come up with a list of, every stock over 80 with a composite rating over 85. That doesn't mean that those are all the things you buy. You go through the list, and then from there, I'll cull that down to my buy watch list, which maybe right now is 20 names from that. And I'm doing that on the basis of the pattern and the technicals, and then trying to understand the story. So MTZ, Mastech, trying to push a pocket pivot, I guess. This is a little one here. No, that isn't. That's not enough. It's got to exceed that. But like I said, we're not really buyers here. MTZ, earnings are looking okay, picking up 25% in the most recent quarter, but nothing thrilling. So, but that looks okay. That's not a bad pattern. So I just don't think you're going to get much upside out of it. And watch, it'll go up 40 points in the next couple days. S&P is having tight closes, consolidation or breakdown forming. Yeah, okay, I'm guessing are the tight closes indicating consolidation? This is what I see. You just got this resistance at the 50-day, and you're stalling out here. You got a couple of days with these down arrows, or what would look like shooting star type patterns on a candle. Dr. K, are you having a gunfight over there? I keep hearing these bullets going zinging by. I mean, I thought you're in Leicester Square in London. You sound like you're in South Central LA.
I use my time machine to go back to the Wild Wild West. So don't mind.
Okay, that's what that is. All right. Yeah, that's right. If it was South Central, it would be more automatic gunfire. So, or East LA, where I grew up. What is O'Neill volume? It's just on the charts. It's just the volume. With a 50-day moving average. That's all. We just named it that. So that's all. It's nothing magic. Do you use Market Smith? We don't use Market Smith. We use Market Smith's big brother, or actually big sister, Wanda, which is the institutional product that O'Neill puts out. Market Smith is actually pretty good, I think, and the next best thing. So I think it's a great tool. If I wasn't using Wanda, I would probably have to use that. Ocwen Financial breaks the 50-day but holds the other day on that was Wednesday, rolling over again. I don't think there's enough there to tell you what to do either way. I don't think I'd buy it. I'm not so sure I'd short it either. What do you think of Shield? Haven't looked at the pattern. Let's see. I mean, this has been I think it's been a dog for a long time. Yeah, there we go. There's the long-term pattern. So, is it going lower? I don't know. It's not really a leader that's breaking down, but it sure looks ugly. I sure wouldn't buy it. I think you'd have to be nuts to try and buy it. Whoops. Okay, where are we at? Kihu is supposed to be taking. I think some of that's blown out of proportion. That Kihu's taking market share from Baidu. And we didn't like this. We talked about this last time, and yeah, it's been trying to break out, but look at the breakout. Boom, boom, and that's what it looks like on a weekly chart. Heavy volume reversal. We don't like it. It's junky. Amazon says your book will ship first week of January. It's actually shipping. We had a meeting yesterday on this, Dr. K, didn't we? The shipping was going to occur, what, like next week?
Actually, I'm not sure.
Okay.
No, I have not. I haven't really discussed that issue.
Someone's asking about this, and I was going to let you comment on this because I need to take a quick 20-second break here. But someone's asking, was IBD premature in calling a follow-through day, which would have been, I believe, was it this day or this day? This day right here, I believe. So I'll let you discuss that, and I'll be right back.
Yeah, IBD, we both, as you know, worked there for several years, and IBD would sometimes contradict itself. Not very often, but when it did, it would create a lot of confusion among us, and it seems like IBD has invented a new rule here with really wanting the market to go higher on the basis of O'Neill's views, and so they created a rule that said, okay, well, we're going to extrapolate the volume that occurred on November 23rd, which was a half day, and say that therefore had it been a full trading day, it would have met the follow-through day requirements. I think that's a little really stressing the test here, and stressing the rules to do that. I've myself, I've never seen evidence that is a beneficial way to create follow-through days in all of my studies on the NASDAQ composite going back to 1973. So when that follow-through day came out, it certainly didn't model any, and I was a bit skeptical myself. And right after that so-called follow-through day, 2 days later we had a distribution day, and that does not bode well for follow-through days when you get a distribution day that occurs day 1 or day 2. And then since then, as we all know, we've had 2 more distribution days. So it's, well, actually I would say, yeah, we've definitely had 2 more distribution days since then. Arguably a third, but no, I don't believe that was a distribution day. So anyway, we'll see how this one pans out. But again, we're in a risky environment, and the price volume action is not looking bullish for this particular FTD.
No, and you can see Apple rolling over. I was also noticing Lulu was looking pretty good earlier. Why is this not? Oh, I know what's wrong here. Yeah, Lulu is starting to reverse, so that's looking pretty good. I don't know. I'm thinking maybe this is going to be a short again. So let's see. Other questions? Yeah, just getting back to that Friday, that struck me as an odd call. And I think that was one of Bill's instinctive calls, but I guess he was right in the short term. The market did move higher from there. But the other thing I think is a problem is they're assuming that if you have a shortened day, 3.5-hour session, that you can extrapolate out the volume to a full day. But I think that assumes that people only trade so much in the morning and only do the rest of their trading in the afternoon, I guess. But how do you know people, because it's one day and there's some trading that may have to get done, that they're not cramming all their trading into that single day, So, and that's kind of fluffs up the volume. Did you mention that point, Dr. K?
Sorry, you keep blanking out. Can you just summarize the last couple sentences you said?
That you can assume that the volume is going to remain constant throughout the day. People could just cram in a lot of volume, cram in their trading before the close, and that would tend to give the volume a sort of an upward bias.
Right, and I mean they may have accounted for that, but it doesn't matter. I mean, it's just I haven't seen evidence of using that rule to extrapolate half-day volume to full-day volume. It just doesn't. It hasn't been particularly reliable, so it's not a rule for my model.
Right. CRM, it's kind of holding in this pattern. I'm not going to be in this environment. I don't think I'm going to go long something like this, but I'm not going to short it. So. Somebody says I got an email from Amazon saying the book will be available 12/28. I think that's right. So you'll see when it's up there. S-Fund, what do I think of it? Not that much, really. Is there something exciting here, Dr. K, that I'm missing?
Not that I've seen. I mean, I've seen this stock before, and it's again, it's a risky name. It's a Chinese name, internet content based.
Oh no, forget it. I'm not. Yeah.
It's got a lot of defects to it, and so I could go on and on and on. Why this is
Yeah, but it's going higher, so they got somebody in it. But it trades 357,000 shares a day. That's way too thin for me.
Just don't let the powerful earnings line on these Chinese companies seduce you into buying them. Because the last few years, most of these Chinese companies have not worked, and they have stellar earnings lines, and it does beg the question: well, is the fundamental data that these companies are reporting legitimate? And I think the market's saying not particularly.
No. And with respect to the IBD call, some of you are commenting that it was wobbly or they're crazy or whatever, but they just make the call, and it doesn't have to work. The second part of any follow-through day doesn't mean you start buying stocks with your eyes closed. There's got to be things to buy. If you have a follow-through in the indexes and there's nothing to buy, guess what? There's nothing to buy. So, Silica Holdings, people are asking about. I've got nothing really to say on this one. It was looking like it wanted to go higher, and it's pretty erratic. It's thinner stock. It's probably got some overhead in here it's trying to work through. So You know, they use the sand for fracking, I guess. So that's been an exciting story. But you know, under the Obama administration, do you see them encouraging fracking or maybe trying to sit on it? I don't know. But I think the stock isn't really going anywhere. There's been some accumulation in the stock up until last week when you saw it get nailed on heavier volume. So I'm not really interested in it. Are you, Dr. K?
Well, I have it on my screen because I am definitely looking for some very bullish price action, and that will be predicated on certainly the Obama administration, and we'll see it turn up in the technicals of this stock. So you know, I'm not ruling it out yet, but I'm certainly not going to be buying this until it proves itself on a technical level.
Right, exactly. And it could be a compelling, like he says, it could be a compelling story. So we're open to it, but right now we don't see any reason to be buying it. So silver and gold, I'll resist for your sake, Dr. K, playing that Burl's Eye song that I always like to start playing whenever someone brings up silver and gold. But in any case, silver was acting better, not holding the 50-day moving average, violating it in here, trying to get back above. If you look at the futures are kind of interesting. It's trying to hold. So, you know, it's hard to say what's going on here one way or the other, but when we look at the macro pattern, say in silver, you're in this big consolidation, and it looks like it could come out here at some point, and it's just a matter of time. Same thing goes with gold. Whoops, got that K in there. You know, you're in this long-term consolidation, and looks like, you know, this was a pretty ugly one. That turned into a nice move. This is another one. Maybe it's a little more like the one today, and that turned into a nice move. But look how long it takes, you know, before the move happens. And then when it does happen, by that time you're probably so bored with the thing you don't want to buy it, and it has a big move like that. And here, same thing here. And this was a sustained move. Notice that after QE started to figure into the market, you had a more sustained move in gold. Not without small corrections and bases, but continued higher. Now you're in this long pattern here that is still, you know, yet to resolve itself. And you're well below the 50-day on the GLD, but you're still holding above this prior low from early November and the 200-day moving average. So it's just kind of hanging out there without any without any conviction one way or the other. So we're just kind of watching them. We don't really, you know, look for a minute. We got excited and look for a minute that they were going to take off. And when you think about it, with the Obama administration and Democrats pushing for automatic raising of the debt ceiling, you know that their intent is that they intend to go further in the debt. That's what they're going to do. They got these big spending plans. They don't want to cut any spending, and we're just going to go further into debt. And I think that was pretty obvious. That's been obvious the whole way, because even the Republicans' plan doesn't cut spending at all. It just cuts the rate of growth of spending. So we're going to go further and further in debt. And I guess you can keep raising the debt ceiling all you want, but at some point I would imagine that the debt ceiling runs into the lending ceiling, where at some point people say, we're not going to loan you any more money, USA. You got any take on that, Dr. K, with respect to gold and silver? So, I mean, I think, you know, they're going to just be printing money and not make the hard choices, and that means long-term gold and silver go higher. You agree?
Yeah, I think long-term is definitely a green light for these things. You know, overall, I mean, they're in basing patterns, so, you know, we have to be patient, but the fundamentals are certainly in line for higher prices in precious metals going forward. You know, as we know, gold's been in an uptrend since 2001, so 12th year of this uptrend, overall uptrend, and I don't. It's not giving any indication that it's going to be breaking down. In fact, it's getting tighter and more constructive. And we saw this pattern, the weekly chart, in 2009 after a long basing period that lasted about a year and a half. And you'll see that the pattern gets tighter and tighter, and that's what we're seeing now. It's getting tighter on GLD. So, you know, it's possible we're going to see a breakout beyond the 174 level, and that's a critical level. You'll see in the current base on the weekly chart, 174 has been the upper limit, and I would love to be a buyer when it crosses 174 with volume and coinciding with the pocket pivot, because the pocket pivot concepts work just beautifully with these instruments.
Yeah. So, you know, and if you try to extrapolate, this is the day, you know, we're trying to extrapolate an SLV, I think, a potential pocket pivot here, if, you know, because that was that Friday, and if you extrapolate the volume out, you know, that was probably flawed in hindsight, I think. But you can see these, technically there's nothing to buy into. Somebody says that the Fed, well, we have one person saying the Fed is a 70% buyer of the debt. Couldn't they become 100% under Obama? Yeah, sure. But what does the rest of the world say to that and to the dollar at that point? And do you get a run on the dollar that leads to a huge break to the upside in gold and silver? So, you know, but I think that bottom line, that's the long-term story for these, and they're probably going to just go higher. So it's 9:09. We're almost been exactly 1 hour. NASDAQ is on for another distribution day. That is correct. So yeah, that's basically what we're looking at here. I gave you a couple things I'm looking on the short side. LinkedIn, maybe the 110 stop, you know, the HLF, the FOSL. But you know, for my money, we've been talking about Google intraday, and it's just continuing on the 5-minute. You can see it's just on a nice steady downtrend, which is nice. And let's see. Let's see here. Google on a is this a daily? It's a 5-minute chart. So you can see what's going on with this. You had your sell signal up here and rolling over and staying down. You also have the same thing going on with Apple. This is the 620 chart. Earlier at the 550 level, you had a sell signal, and it's been going downhill ever since then. So looking pretty weak. Here at 633, 634. You know, so maybe it's headed for that 505.75 low. Anyways, I think that's all we have. Any other last questions? No, that looks like it. We've gone for an hour. Dr. K, you got anything to add?
Nope.
So, you know, summarize real quick. The market's looking like it's having some trouble here. So we're kind of vigilant on the short side. That means also watching for a sell signal in the market direction model, should that hit. And, you know, you could go into a second leg. So there's also potential, though, some deal announced on the fiscal cliff, and you get this knee-jerk rally to the upside, so you do have to guard against that. So
yeah, the odds are that the model is going to go to a sell signal before it goes to a buy signal. But again, that's the future, so we really don't try to make any predictions.
Right, exactly. And I think if you're using, you know, if you're trying to come in and short some of these stocks, all right, what happened to the, that should be a daily chart. What happened to my other little intraday chart? Did I close that up? Maybe I did. Let's check something here real quick. There it is. Yeah, and so, you know, the best thing to do if you're going to try and test the short side using our little short-term gizmo, you can see that you're getting some good signals in Apple and Google today. I'm on those today. And that'll keep you out of trouble, because if they flip back the other way, you can see yesterday Apple was in serious trouble yesterday, right off the opening, breaking down, and then turned right around 533. So, you know, you don't catch all the profits, but you can kind of see that you get a bit of a downside capitulation here on this big bar to the downside on huge volume early in the day, and the thing breaks down, and then you get a buy signal again, and it runs up, and then today now you got a couple of you get a big sell signal that works. You'll notice there's some here that don't work, chopping around late in the day, but that's late in the day after the buy signal. So I think at the most, you know, at the least, you're probably covering a short position and then waiting for it to set up again like it did today. So that worked out pretty well so far. And that's kind of where you're at on these, and that's one way to be testing into rallies without putting yourself under a lot of risk. You know, given the fact that there is potential for the market to turn on some news, although that's, to me, not entirely clear. The fiscal cliff, they could just go ahead and drive on over. It almost seems like that's what they want to do. So anything could happen. So I just think just stay focused on the price volume action and on the action of the indexes, which is right now telling you that you're at a potential area of resistance. Not a lot of leadership out there, so be careful. And that's about it. So thanks, everybody, for showing up once again, and we'll catch you next week. Take care.
So long, everyone.